Bull Bear Buzz Podcast for decoding markets, fueling minds. Welcome to the deep dive. We're looking at Mahindra Holidays and Resorts India Limited, MHRIL, today, and they've posted some really eye-catching profit numbers for Q4 and the full year FY25.
Seriously eye-catching. You see things like standalone profit after tax, PET, up 61% in the quarter. That definitely makes you sit up and take notice.
Right. And even consolidated was up 12%. For the full year, standalone PAE climbed 25%, consolidated hit 37% growth. And that's all excluding some one-off items.
Which is important. Stripping those out gives a cleaner picture of the core business performance. But yeah, strong performance is the immediate takeaway.
Exactly. And that's what we want to unpack here. We've got the transcript from their earnings call held back on April 25th, 2025.
So we're going beyond just the headline figures.
Yeah, our mission for this deep dive is to get into the strategies, the plans, what's really driving these results. We want to give you, the listener, a really clear, concise understanding of what's going on with MHRL.
Looking under the hood, basically. What levers are they pulling? What's working well, and what does it suggest about the future?
Okay, let's start with that robust financial performance. For Q4 FY25, standalone total income, INR 398 crores. That's up 6% year-on-year.
Okay, solid top-line growth.
But the EBITDA earnings before interest, taxes, depreciation, and amortization that jumped 41% to INR 132 crores, the margin hit 33%.
Wow, okay, a 41% EBITDA jump on 6% revenue growth. That points to some serious margin expansion, better efficiency or pricing power, perhaps.
Seems like it. And the standalone PA, again, excluding those one-offs, came in at INR 57 crores. That's up substantially from 33 crores last year.
Yeah, that's a significant bottom line improvement for the quarter.
And the full year FY125 standalone numbers echo this. Total income was INR 1,545 crores, up 8%.
All right.
EBITDA hit INR 492 crores, up 18%, with a margin of almost 32%.
Okay, so consistent margin improvement across the full year as well, though maybe not quite as dramatic as Q4 alone.
And the full year standalone PAT, ex one-offs, INR 197 crores. So yeah, the trend holds for the full 12 months.
It suggests this isn't just a one-quarter fluke. There's some sustained positive momentum here.
No, those one-offs they mentioned seem to be some tax refunds last year and Forex movements. Standard stuff to exclude for a clear review, right?
Yeah, absolutely. Things like tax refunds or currency swings aren't part of the day-to-day operations. Taking them out helps you see how the actual business is performing year over year.
Also notable, their cash position. As of March 31st, INR 1,555 crores. That's quite a healthy pile of cash.
Very healthy. Gives them a lot of flexibility for investment, expansion, or just weathering any potential downturns.
And deferred revenue grew to INR 5,736 crores. That's basically members paying in advance for future holidays, isn't it?
Exactly. It's a liability on the balance sheet, technically, but it represents future committed revenue. Seeing that number grow is usually a very positive sign for a membership business like this. Shows confidence and locks in future income.
Okay, let's shift gears to their strategic focus. Inventory addition seems huge for them. They added 520 keys and 7 new managed resorts just this past year.
And across quite a geographical spread, too. Bharatpur, Pavagad, Patkote, Agra, Mysore, Ranthambore. Even their first one in Andhra Pradesh, Dindi.
So they're adding capacity both by increasing rooms of keys and by adding entirely new locations. What's the significance of doing both?
Well, adding keys lets them serve more members, especially in popular spots. Adding new resorts broadens the appeal of the membership overall. More destinations, more choices, makes the whole package more attractive.
They've got 4 more projects, Greenfield and Brownfield, in the works, and they sound pretty hopeful about getting at least 2 of the new bills, the Greenfield ones, live by the end of this fiscal year.
Which feeds into their big target, 10,000 keys by FY30. They're on 5,850 now, so they're making steady progress.
Yeah, it's ambitious, but they seem committed. For FY26, they actually expect to add more keys than they did in FY25.
Interesting, even though they're also exiting some associate resorts.
Right, they mentioned that getting rid of some that weren't up to scratch based on quality checks and member feedback.
That's actually a good sign too, isn't it? It shows they're focused on quality, not just quantity, pruning the network where needed.
Yeah. They also mentioned a specific goal, adding 1,000 rooms over the 5 quarters starting January 2025. So the pace is definitely picking up.
And that likely explains why they're forecasting higher capital expenditure, higher CapEx for FY26.
Exactly. They pointed to finishing up big projects, Kampatapur in Maharashtra, Theog in Himachal Pradesh, plus planned refurbishments for 3 or 4 older resorts.
So it's that two-pronged approach again.
Yeah.
Building new stuff and keeping the existing properties fresh and appealing. You need both to maintain quality.
Absolutely. Now let's talk premiumization and their member strategy. This seems like a really key shift.
Yeah, they've explicitly talked about focusing on premiumization and being more targeted in who they sign up.
Which has led to fewer members being added overall.
And it's a big but much higher average unit realizations, or AUR.
The numbers are quite something. Full year FY25 AUR was INR 5.73 lakhs. That's up 39%.
39% increase in the average revenue per new membership sold. That's significant.
And Q4 was even more dramatic. INR 7.7 lakhs AUR, up 82% year on year.
Whoa, 82%. What's driving that? Is it just higher prices or different products or?
A mix, it seems. They mentioned upgrades from existing members were a big factor, up 14% year on year for FY25. So people are trading up.
That makes sense. Existing members choosing higher tiers or longer durations. And maybe the new members they are adding are opting for the more expensive packages from the get-go.
Seems plausible. It could mean better resorts, more perks, maybe longer-term memberships being pushed.
This focus on premiumization, it changes the profile of the average member over time, potentially attracting a demographic willing to spend more.
In terms of numbers, they added 12,400 members in FY25. Total base is now 304,000.
Okay. And how are they acquiring these new members?
Interestingly, 59% came via referrals from existing members or through digital channels.
That's a high percentage. Usually a good sign, happy members referring friends, and efficient digital marketing. Lower cost per acquisition, potentially.
Yeah. They also talked about the member-to-room ratio improving, down to 52 from 56 previously.
Lower is generally better there, right? Means potentially better availability for members when they want to book.
Right. They think the ideal stabilization point might be somewhere around 45 to 48 members per room, based on refusal rates and demand patterns.
Getting that balance right is crucial for member satisfaction in a timeshare model. Too high, and people can't book. Too low, and maybe you're not maximizing revenue.
So the big question is, can these huge AUR increases continue? Or will they need to focus more on adding volume, more members going forward?
Management seemed to suggest the AUR might be nearing its peak, but they'll still get benefits from recent price hikes. It sounds like maybe you're rebalancing towards growing the member base again, but maybe at this higher AUR level.
Makes sense. If AUR growth slows, volume becomes more important again.
Exactly. Which ties back to why they're pushing so hard on adding inventory. You need the rooms to support more members.
Okay, what about the resorts themselves? How did they perform?
Resort revenues were up. Q4 FY25 saw INR 107 crores, up 14% year on year.
And the full year?
INR 396 crores, up 8%. They put it down to higher volumes and consistent occupancy.
So people are going to the resorts and spending money while they're there.
Seems like it. They mentioned overall market conditions are strong, with high average room rates, ARRs, and occupancy across the sector, although they did acknowledge some specific temporary issues, like weather impacting Sikkim.
Right. They also touched on the mix between leased and owned resorts. It sounds like it might shift more towards leased in the short term, maybe 70% leased, 30% owned.
Yeah, they indicated that possibility, but also stressed it's dynamic. As their big owned greenfield projects come online, that ratio could shift back.
Why lean more towards leasing, even temporarily?
It can be faster, maybe less capital intensive upfront than building from scratch. It gives them flexibility to scale up their network quickly in certain areas. But owning gives long-term control and potential appreciation. It's a balancing act.
Got it. Let's talk costs, specifically sales and marketing. They seem to be optimizing here.
They broke it down quite nicely, actually. 4 main parts. The offers they give new members, costs for lead generation and events, incentives for members making payments, and general marketing spend.
And the outlook. Offers stay low, lead gen might go up as they expand, payment incentives are likely gone for good, and marketing spend might increase with growth.
It sounds like they're trying to be efficient. Keeping promotional offers tight fits the premiumization theme. Investing more in lead gen makes sense if they want to grow. Cutting payment incentives saves costs directly.
They also mentioned about 11,500 member upgrades happened in FY25, people moving to higher seasons, apparently.
Which again reinforces that members are seeing value and are willing to pay more for better access or quality.
And they clarified something important about pricing. That big jump we saw in new member AUR in Q3 and Q4
Yeah.
wasn't primarily due to a big price hike in, say, April. It was more because they shifted from selling a 3-year product to a 5-year product.
Ah, okay. So the product mix changed significantly, leading to a higher average transaction value. That makes more sense than just an enormous price increase on the same product.
Yeah, important context. Now, what about their international operation, Holiday Club Resorts in Finland? Sounds like it's facing some challenges.
It does. They mentioned the economic downturn in Finland impacting things, plus some bad weather patterns in Q4. Less disposable income means less spending on leisure, typically.
They're hopeful for a recovery, though.
Yeah, tied to the Finnish economy improving. And interestingly, they mentioned a potential positive impact if the conflict in Ukraine and Russia resolves. Apparently, they used to get high-spending Russian customer.
Right, so for now, they're just focused on managing the Mechka there.
Pretty much. Keep things steady, manage costs, wait for conditions to improve before making any big strategic moves, it sounds like.
And that shift from the 3-year to the 5-year product here in India sounds like it went really smoothly.
Yeah, they said the 5-year basically just replaced the 3-year volume almost perfectly. Suggests customers were okay with the longer commitment and higher price point for the perceived value.
They were asked about the weak IT sector potentially hurting membership sales.
What was the take?
They said they don't specifically track IT professionals. Their targeting is more based on income levels overall. And discussions with sales teams haven't flagged any major impact from that sector specifically.
So their member base seems reasonably diversified across different industries, which is good for resilience.
Quick point on tax rates for FY26. Standalone, expected around the standard corporate rate plus surcharges. Consolidated maybe around 35% because the Finnish operation has a lower rate. Just some housekeeping for financial modeling.
Good to know. Helps frame future profit expectations.
How are the brand new resorts doing? Like Patcoat, for example.
They didn't give data for specific resorts like footfall, but they said the general trend is occupancy picks up as word gets out and member reviews come in. Resorts launched just back in Q3 FY25 are already seeing strong occupancy, like 80–85%.
That's pretty quick uptake. Shows the demand is there.
Definitely. And they emphasized continuous enhancements at all resorts based on feedback, upgrades, upkeep activities, aiming for high satisfaction scores everywhere.
Those brownfield expansions, adding rooms at existing resorts in Jaipur and Chandigarh, are they on track?
Yep, expected to be finished within FY26, probably in the second half. So more capacity coming online in popular spots.
They tried an interesting experiment with food and beverage pricing.
Oh, yeah. What was that?
Lowering prices to see if more members would eat in-house, the capture rate.
And did it work?
Apparently not significantly enough. They didn't see a big jump in capture rate, so they'd become more selective with discounts. In many places, they went back to original prices without losing business, and in some, it even helped profitability.
Interesting. Shows they're willing to test things and follow the data, even if it means reversing a change.
They wouldn't give specific guidance on member additions for FY26 or details on referral programs, but they do expect membership to grow overall for the year.
Fair enough. Companies are often cautious with forward-looking guidance on specific numbers like that.
And that big 10,000 key target by FY30, how confident are they?
They gave a sense that they have good visibility on the pipeline. Agreements covering maybe 60–70% of the needed additions are apparently in place across various stages, both owned and leased projects.
So a decent chunk of the path is already mapped out, at least in terms of potential deals.
Seems so. It adds credibility to the long-term target.
They also talked a lot about the overall Club Mahindra brand perception, how they're trying to elevate it.
Through the renovations, higher standards for new resorts.
Yeah, and also focusing on getting members they can actually service well. Things like minimum down payments, checking income levels, trying to ensure a good fit. It's all part of that premiumization journey.
Makes sense. Aligning the brand promise with the actual delivery and the target customer.
Couple of clarifications they made. Annual subscription fee, the ASF, is the same for members in the same room category each year. Doesn't matter when they joined. It's about covering current resort running costs.
Okay, straightforward enough.
And the price difference between what a retiring member might have paid originally versus a new member joining today, they said it's too complex to give a simple number because of all the different products and tenures over the years.
Understandable. Comparing apples and oranges from different eras.
Circling back to sales and marketing costs for adding new members, they reiterated the two main levers: changing the offers, which scales with units sold, and changing the lead generation or geographical presence, which is more of a strategic investment, not directly linked to units.
Right. Plus, that removal of incentives for paying EMIs or ASFs also impacts the overall cost structure, even if not strictly a sales cost.
And they expect to reinvest in marketing as they grow while still optimizing channels.
Standard practice for a growing business. Spend money to make money, but do it smartly.
That member-to-room ratio target, again, they stressed it's not a fixed number they're chasing.
More about monitoring refusal rates.
Exactly. Keeping an eye on how often members can't book, where and when they want, at different resorts and clusters, and using that data to decide where more inventory is needed. That 45-48 is just an estimate of a comfortable zone.
A dynamic management approach based on actual usage data. Makes sense.
How about the performance of newer resorts versus the older, established ones?
They said the management style and the philosophy behind the customer experience are consistent across the board. Standard features like their Happy Hub activity centers are in all resorts.
But do new ones perform differently initially?
Yes, there's usually an initial lag in occupancy for brand new resorts. It takes a few months for awareness to build and for them to hit stride. So resorts opened in the last year might perform slightly differently than established ones, and very recent openings might lag a bit more initially, but they generally catch up.
Okay, and they confirmed again. No specific medium-term financial guidance on revenue, EBITDA, or margins.
Pretty standard for them, it seems. They focus on strategy and operational updates rather than detailed financial forecasts.
We talked about upgrades being strong. Is that what they mean by cross-selling?
Primarily, yes. They confirmed cross-selling mainly refers to members upgrading, often from lower season plans to higher ones, which gives more booking flexibility.
And that's happening quite a bit.
Yeah, they highlighted it reflects customer confidence and mentioned that 14% year-on-year growth in upgrades again. It's an active part of their sales effort.
Finally, looking ahead, what are the key strategies for driving revenue and member growth beyond just the price hike they took in April?
It sounds like a lot of focus on improving sales productivity and conversion rates.
How?
Better targeting in lead generation, managing their different sales channels more effectively, like improving the web channel, and really leaning into member referrals.
Using data and tech for referrals.
Exactly. Trying to understand which members are most likely to refer based on their history and profile, and then actively encouraging it. Also, simplifying the product itself to make it easier for customers to understand and buy.
Makes sense. Making the sales process smoother and more targeted.
Pretty much. It's about efficiency and leveraging their existing member base.
Okay, so let's try and summarize the key takeaways from this deep dive. MHRIL delivered strong financials, clearly driven by adding more resorts and rooms, and this big push towards premiumization, higher prices, maybe better quality.
Yeah, the strategy seems to be about expanding capacity while also increasing the value proposition and the price point. Inventory growth and premiumization are the two main engines right now.
They're dynamically managing their resort portfolio, leaning a bit more towards leasing for now perhaps, but with owned projects coming. And they seem generally positive, despite those headwinds in Finland.
The core focus is clear. Grow the network, enhance the member experience, and attract and retain members who see value in that premium offering.
So here's a thought for you, our listener, to mull over. With MHRIL betting heavily on premiumization and adding more resorts, how will changing travel habits in the overall economy in India shape their growth and keep members engaged in the long run?
That's the key question, isn't it? How well does their strategy align with where the market is heading? It'll be fascinating to watch how external factors influence their trajectory.
Definitely. Now, just a reminder before we wrap up, the information provided is for educational purposes only and not financial advice. We are not SEBI-registered advisors. Investing in stocks carries risks, including potential loss. Consult a SEBI-registered advisor before deciding. We are not liable for any losses from decisions based on this information. And for unbiased market update, please subscribe to Bill Bear Buzz Podcast.
Absolutely crucial to remember that. Do your own research and consult with a professional.
If you want to dig even deeper, the full earnings call transcript is usually available on MHRIL's Investor Relations website. And feel free to reach out if this deep dive sparked any more questions for you. Thanks for tuning in to The Deep Dive.